then quickly figured out to get 3 of us out of work, we're going to have to sell quite a lot of deals. Like, it's a pretty unsustainable business model, and you're always trading your sort of like your time for the money. I think we were 3.6 million deep.
It's important to have that in business. It's only like usually when I go away on holiday that I'm like, oh shit, well, why am I not doing that anymore?
I mean, we were, I think, 23, 24 when managing 9 HMO refurbs at once.
Like, obviously, 5 property purchases a month. That's a lot. For anyone to do that in a year is a lot, never mind a month.
And the risk is much less. You can bail yourself out of 100 grand. Much harder to bail yourself out of £1 million. Yeah, your cash flow takes a hit because there's no way of making quick money in property.
I dread to think what, the stress levels or sleep levels, anything during that period of time.
Horrific. Yeah, horrendous.
Before we kick this episode off, I want to let you know about our next show that will be taking place in Manchester on the 4th of September at Manchester City Stadium, the Etihad. Doors to the show will open at 10 a.m. They'll shut at 3 p.m. We have 12 keynote speakers, multiple exhibitors, and lots of opportunity for networking. Details for the show are in the description. Tickets are free. We hope to see you there. Welcome to another episode of the Property Developer Show, the podcast. Today, I'm joined by Aston Haslam, a young investor based in Manchester who's grown a massive portfolio over a very short period of time. So I'm looking forward to our conversation today. Aston, welcome to the show.
Thanks for having me, mate.
Pleasure. So really, let's delve into obviously where your property career started, because I know you have achieved a lot in a very short period of time, which is always quite intriguing to understand the journey of that, because I know from what I've heard and seen from other podcasts, you certainly share the downsides to quick growth and obviously the headaches that sort of come with that. So let's start from the kind of beginning where the property journey started.
Sure. Yeah. So I started my journey with my 2 business partners, Adam and Alex. They are twin brothers. And we were all in full-time work. So Alex worked in tax, Adam worked in insolvency, and then I worked in e-commerce. So I left university and went into a 9-to-5 job. Was there for a year and I hated it, to be fair. I didn't mind the job, but I didn't like the 9-to-5. I'm pretty much unemployable. Like, I have to work for myself. So then we started deal sourcing. So Adam and Alex went and did a couple of free events. And then we started deal sourcing. So Adam left work first. He did an incredible job of getting to know local estate agents, building a bit of a reputation. And then we just very quickly figured out that the thing that you need in property is investors, whether that's to sell deals to monetize opportunities or to raise money. So we just doubled down very quickly on finding investors. So then we sourced a few deals. I think we probably sourced about 10 deals, nothing crazy. And then quickly figured out to get 3 of us out of work, we're going to have to sell quite a lot of deals. Like, it's a pretty unsustainable business model, and you're always trading your sort of like your time for the money. So then we started opening up the conversation with these investors of borrowing money off them. And so we did that. And then sort of the rest is history. We borrowed the first investor that we borrowed money. The plan was to borrow £1 million off. And the aim was to buy 1 house a month for the next 12 months. I think we were 3.6 million deep from this one investor. And then we ended up buying 5 houses a month for 5 months. So we bought about 55 HMOs. Well, they were terraced houses that we turned into 3 to 6 beds, leased them to a supported living. And then we sold half of them overseas into China, Hong Kong, UAE. And now we own 26 HMOs, and we've got 16 flats, a few developments, and just constantly buying.
Amazing. So, yeah. Amazing. I mean, I suppose delve into the investor side, to land an investor early on, because how old were you guys then?
22.
So yeah, to land an investor at 22 years old that's willing to put in £1 million from the off. What A, where did you find that person? And B, what made you you guys collectively so investable?
Yeah, I think so. Finding that person was from us just being resourceful. It wasn't a friend, but it was a friend of a friend. And we'd never spoken to this person before. And so one of Adam and Alex's friends, he was in property himself, and his mate just sold his business for £46 million, mid-30s. Nice. And he wanted to invest in property, but Adam and Alex's friend couldn't help him because they weren't deal sourcing. They were doing service accommodation. So he passed him to us. And then we had that conversation. I think it helped because he could tell like we were young, we were hungry, ambitious, but we weren't stupid. Like we were well educated. Adam and Alex had good jobs, tax and insolvency. So, a lot of like accounts and numbers. And I think he sort of saw himself in us. He was a young guy, he's made tens of millions of pounds, and like £1 million to him was not a lot of money. And that sounds stupid, but I think he just sort of saw our vision. And probably important to note is so before he came on board, the first deal we did, I borrowed money off my dad. And that sounds like my dad just gave me the money. But to do that, he refinanced the family house. So my mum was livid, absolutely fuming, like didn't speak to me for 6 months. And then we basically went and bought two shitholes in the northeast. We bought them for like 40k. We put a lease with Mears, housing partner up there, so a 5-year lease. And then we sold them into Hong Kong and made about 30k on each. And we were like, whoa, like me and Alex were still in full-time work at this point. And so we did prove the model by using somebody else's money, which was a risk for my dad. But everything was proper. Investment agreement, we paid interest. If we didn't pay the money back, he was taking the assets. We signed contracts and everything. So we proved the model to him first, which meant that he could see it all working. And that's when he went in.
And you say that in quite like a little bit of a discredited way to yourself, but I think it doesn't matter where, you've still got to be resourceful, whether you are raising money from family members, friends, associates, friends of friends. You've still got to be resourceful for that approach. I mean, I've approached people in my family, and when I was early on, and said, can I? And they were like, no, probably because I didn't sell it very well, or they didn't trust me, or whatever it might be. So there's still an element of hard work that goes into that.
We've done it tons as well since. Like Adam and Alex got their dad's cash's pension early, and it's good for him because he can take out X amount tax free. And then, he went and bought a property and loaned us money since. And I think you've just got to do what you've got to do, especially if you're young in property. But then from that, we've been able to raise tons more. We've raised just shy of 10 mil at the minute, which has helped us do loads of other things. And I think because we proved ourselves at the start, that then meant that we could go and raise more money and do more deals.
No, it makes sense. It's that credibility growth, isn't it? And I suppose getting that for those first few investors, deals, that's the hardest part. But then once the momentum starts, then, I was really fortunate that my business partner at the time had an affiliate marketing business, sold out, had money, I had the knowledge, having worked in the industry for years. And that's, that was my break, that was my opportunity. So I think there's so many different ways to skin the cat with raising money. You've just got to go out there and do it and be resourceful and take risk whilst you're young, particularly. So kind of, I suppose, raise the money, grew the portfolio really quick, which is so difficult to do. I mean, I dread to think what, the stress levels or sleep levels, anything during that period of time must have been tough.
Horrific. Horrendous. I mean, we were, I think, 23, 24 when managing 9 HMO refurbs at once at any one time.
Yeah, that's ridiculous.
And it was mad. And we quickly realised that you need to scale the team. So we scaled the team. We ended up having, I think it was like 9 staff, ops manager, admin, finance, 2 project managers, acquisitions, everyone's full time. So you then take on a lot of responsibility of, our wage bill goes from hardly anything, because it's just me, Adam and Alex, to 30, 35 grand a month. And it's, property is not quick cash either. So I think now when we look at property companies, you look at people building skyscrapers in centre of Liverpool or Manchester, they've only got like 5 or 6 staff. And you always think like, how? Because they're doing so much. But we quickly realise that you've got to outsource. You've got to use people that are better than you in every single different sort of industry, but not necessarily have them on board as staff. So that's something we learned really quick because, your cash flow takes a hit, because there's no way of making quick money in property, especially 30, 40 grand a month. So it was a tough time, but it's good, learned loads of lessons. And we wouldn't have done it without the team that we had in place. But now we sort of understand sort of the correct people that we need in place, rather than just, a person on a seat that can just take a little bit of weight off your shoulders. I think obviously you got subcontracting side and all that, which I'm assuming that's what you kind of alluded to with different skill sets. And we had some builders on board at the start, and then quickly realised that when they weren't paying weekly, it's just a nightmare. But it worked well. It worked as like a conveyor belt, like an electrician would do. First fix on one house, then he'd go to the next one. And by the time he was finished on like the 8th house, he could come back and do the second fix because the joiners and everybody had been in. So it was literally like a conveyor belt. It worked really well. And I think there was 4 build teams of 10, 15 lads on each.
Wow.
So yeah, it was a big operation. We've scaled it back since because it's probably unsustainable. You don't sleep much.
No.
And there's no time off.
Yeah.
But I think that's with any business at the start, like you're not going to get time off.
No, definitely not. It's 24/7. If you're particularly in property, and if you're running other businesses as well, obviously we can come on to the other bits you've got spinning at the minute. It's literally non-stop. So in terms of then, I suppose, really scaling up quite quickly, what was kind of like the turning point for where you guys were like, I don't think this is sustainable. We need to restructure. We need to scale back a little bit. And, where's that ended up now? What's the business look like now?
Yeah, so I think it's when problems start to happen is when you actually realise that what you were doing was wrong. Because like, it sounds stupid, but we didn't diversify. We were doing HMOs in one area. We worked with one provider because we worked in supported living. And I think when the times are going good, you just double down. And you hear everyone saying diversify, but it's actually easier said than done. Because when it's going well, you just want to crack on and it's never going to fail. And then we had a provider that went bump on us. So we were 45 grand a month cash flow net. And then they went bust.
Wow.
So we went to 0 overnight. And all these people that do supported living and say, what happens if a provider goes bust? And then you get some shitty little answer of, it's all right, you just release it to a different provider. Obviously, we've been through the full A to Z process. And me, Adam and Alex sit there and we're like, really? Is that what you do? Because it's definitely not. So when things like that go wrong, you've got to pivot. So we had to get rid of a lot of staff, and our business model has changed completely. So we got 26 HMOs at the minute. We kind of work directly with the council, so we don't do leases really anymore. I don't like the lease model. I think it is incredibly risky, even though it's meant to be the opposite. But it depends on the provider, and 99% of providers are shit, to be honest. We've got a couple Ofsted regulated like children's homes, which are good. I like that model because it's regulated by Ofsted. So the provider that we've got is probably the best provider in the country. Insanely good. Their values are in the right place. And so we've got a couple of blocks with them, which we'll lease and we'll do 15-year leases on. But other than that, we have sort of like direct to council HMOs, Ofsted regulated children's homes. And then now, in a weird way, we're actually scaling back. So we're just going to build a massive buy-to-let portfolio. Super simple. 80 to 150 grand houses, less risk, less money, less problems, easier to control, and just build that out and probably get to 100 buy-to-lets in the next 3 to 5 years.
Nice. In Manchester or across the UK?
All over.
Right.
We're not precious on location. Obviously, when you're looking at like 80 to 150 grand, you're probably looking at doing a lot in South Wales at the minute. I mean, it's a great growth area. Rental demand's so high. The rents are high as well. And so the return's great. And we have numbers of, after paying source fees, PM fees, and interest to the investors, if we can leave 15K or less in a deal, then that's great for us because we're probably making like 50% return on cash. And then if we can just build that portfolio up, then that's what we're going to do.
How are you finding things with like leveraging at the minute with mortgage rates? Obviously the margins are quite tight at the minute. Have you got diversified in terms of, mortgage rates that you tied up, 2 years ago, 3 years ago? Is that kind of balance in the portfolio at the minute?
Yeah, so we don't have any mortgages at the minute.
Right, okay.
So the way we've structured the finance is we've always used full investor cash to buy. And our big portfolio of HMOs, we're going to do a big refinance on that in September, which will release a lot of money. So we're going to do that on a hybrid valuation. So that's a mixture of bricks and mortar and commercial, which not many people know about. Because there's a lot of people saying you can get commercial vals on 4-bed, 5-bed HMOs, and realistically you can't. So with sort of like a council, not a contract in place, but when we show the banks the model, they can give us a hybrid valuation. So we'll be doing that on the big portfolio. And then on the buy-to-lets, we'll use investor cash to buy, and then we'll refinance ourselves back out But at the same time, for every 3 that we keep, we'll do a flip alongside it. So
Nice.
we don't have to rely on our own cash flow if we leave 15K in a deal, the big question everyone asks is, well, how do you pay the 15 grand back? So we do that by just doing 1 or 2 flips that will make us 20 to 30, 40 grand. And then that's how we'll pay it all back. So we're not leveraged at the minute. I guess we are to the investors, but you've got good relationships with investors that they won't stick at 10% for 12 months. We'll long it out, and basically we'll do it on a product by product basis of we'll figure out the right time to refinance.
Sure, yeah, that makes sense.
So it's very different.
I think just on the 4-bed, 5-bed point, I don't know why anyone would get a commercial val on those, because I don't think the cash flow is there personally. That's my own personal opinion. There's people that do it. Good.
I agree.
But the exit, it's only going to be sold as commercial because you've got the leverage there. It's great for pulling your money out, but the risk that comes with that is huge. I don't think people kind of think, oh yeah, get all my money out, looks great. Yeah, it does. But what's the risk factor with that? And obviously, from spinning all the plates and obviously losing the social housing provider, stuff goes wrong.
Yeah, I see it all the time of people getting commercial vals on even 6-bed HMOs when there's a few studios and stuff in there. But, we have a very specialist HMO broker. He only does HMOs. And even he would say to us, like, you cannot have a portfolio of just commercial HMOs because it's so risky. Like if the asset's worth 300 grand and you're borrowing 450 against it, like that to me is only going one way in the next 20 years.
Yeah.
And you got to make sure the income's good. You got to make sure that the rental demand is super high. And I think back to your point of the HMOs, I think the first general rule of thumb, 3 bedrooms, covers your costs, and your other bedrooms are profit unless you have any major maintenance stuff. So if you've got a 4-bed and one goes empty, then you're just covering costs. So that's why obviously commercials work on 7 beds and above, potentially 6.
Absolutely, makes sense. So kind of looping back then to, I suppose, operational side of things, what kind of steps did you take to make the operations more effective? Obviously, 5 property purchases a month that's a lot. For anyone to do that in a year is a lot, never mind a month. So what kind of, I suppose, steps did you take to really create an efficient process?
CRM systems.
Right.
We're young lads. We're terrible at like tracking things. Everything is in our heads. It still is to this day, to be fair. But we do have CRM systems, which we got an ops manager, admin, and then finance guy. So those 3 people would work insanely well together. So like our acquisitions guy would go out and find the property, put the offer in, and we wouldn't even sort of need to know about that offer. So we made it as if like we could go on holiday for 12 months and we'd still buy. That property would then go to the admin, which would then go to the ops manager, who would manage the conveyancing. When that was onboarded, a few weeks before, they would schedule in with a project manager to go view, schedule the work, floor plans, etc. We'd complete, project manager would take it through the build, obviously working with a finance guy in terms of the money getting paid to the contractors, and then the ops manager would do all of like the back end of EPCs, building regs, fire risk assessment, everything else that comes with it, and then lease the property. And then that's where sort of we take over. So my role in the business has always been raising the money and then exit. So that's where when the property was done and we had pictures, videos, 360 tours, everything like that, I would then take it out to market to agents in Hong Kong, for example. But yeah, CRM system was great because now we've got a CRM system where we can click into any property and it drop down. We can see like before pictures, before floor plan, after gas certs, EICRs, absolutely everything is in there. So
what's the software called?
We use Monday.com.
Okay, I've heard of that.
I think Mackey's and quite a few other big companies use it, even Uber.
Right.
But yeah, it's good. I think it's cost nothing, like 10, 15 a month.
Oh, wow.
So it's really good. It's good for managing properties.
Shout out Monday.com then.
Yeah.
Hopefully they'll plug this, they'll sponsor this episode now.
Isn't it? Yeah, it's good.
So I suppose fast forward to today then, obviously you're still spinning the refurb side of things, but you've got the network as well. What sort of included in that? Yeah,
so we were getting frustrated with people I guess, paying fortunes for education, especially when the education is terrible. And education that doesn't come with support. So we built basically like a platform called AFPI Network. So AFPI being our property company. And essentially what it is a group of high quality individuals within property or looking to get into property to join basically what we've built. So it's launched on a software. It's a full educational platform, but also support. And then we have tons of events. So imagine you could take like all of my knowledge, Adam and Alex's, out of our head and put it onto one platform. Everything's on there. Every single property strategy, contact details of supported living providers, all the legal contracts, absolutely everything. But at the same time, there's only going to be 100 people in there. So it's not a network with 1,000 people in. It's a very close-knit community where if you join, you're getting in circles with, yes, people that started, but are motivated like I've never seen before, but then people with 100 houses who are worth tens of millions of pounds. Our events are super different. It's not someone stood on the stage and speaking. It's, we're going out having fun. So we're going to the races. Like we were in London last weekend, went to Flight Club, we're out in Soho till like 4 a.m. And it's just a very different event where you break the ice and everyone gets to know each other and everyone can work together. Very transparent. It's going to get to 100 members, 1 in, 1 out. And that's just the way it is.
Nice.
But it's a big education platform, but you've got me, Adam and Alex and everybody else in the network in your back pocket. So any question you've got, any time of the day, any day of the week, you can put a question in the app and we'll get back to you within like an hour. So there's no emailing coaches or anything else. Like if you come into the network, you've come in to learn from us, like our mistakes, our lessons, our fuck ups. So that's what you sort of get access to.
Nice. Let me just pause this episode for a moment just to quickly introduce you to our episode sponsor, the Property Finance Collective. Transforming visions into reality requires not just a great idea, but the right financial support and the best possible team around you. Specializing in development finance, bridging finance, and commercial mortgages, the Property Finance Collective are there to help you navigate complex markets to secure the funding you need, as well as being part of your team that you can rely on. With a flair for creative deal structuring, they tailor solutions that fit precisely with your project demands, ensuring speed, efficiency, and flexibility. They want to help you make the impossible possible. Now let's get back to the episode. So kind of on the educational piece then, if you've got young Aston here again, he's thinking about leaving his 9 to 5. What advice would you give to him? What would you do potentially different that you did, obviously?
Yeah. I wouldn't do anything different. We cracked the code straight away. We figured out that the number one thing in property is finding investors, because then you can monetize any opportunity, whether that's sourcing a deal, whether that's trading deals, whether that's like back-to-backing or anything like that. But then you can also raise money from them. The number one thing that we focused on was investors. We didn't focus on the deals at the start, and we still don't. I don't go and find my own deals. I buy off deal sources. So if there's any good deal sources out there, hit me up. Because we don't sort of waste our time. I don't want that to sound bad. It's just because we've got so much going on. I don't want to have to go view 100 properties to buy 5. So all we focus on at the minute is just money. And for us, property is just a finance exercise of investor to the solicitor, buy it, refinance. And so I think if you're just starting out, just focus on raising the money. Don't focus on, and this is my personal opinion, I wouldn't be focusing on loads and loads of rent to rents or loads of deal sourcing. Deal sourcing is great because you come across investors, but I wouldn't be sat there thinking that you need to be selling like 1-2 deals a month and putting pressure on yourself. I'd focus on raising the money, whether that's through social media, getting in the right rooms with people. I mean, I literally moved house to raise money. So just get yourself in environments where you're going to be able to raise the money. So I moved from North Manchester to Cheshire. So even my local pubs, there's Premier League footballers in there that I can speak to. And I think you've got to change your environment is probably a big thing that I'd say. You don't have to take it literally, like move house.
Yeah.
But simple things like instead of going to pure gym, like if you can, go join a country club. Because the people you're going to be speaking to in a country club are doctors, surgeons, dentists, and that's where you're going to have more success.
Yeah. And people love, there's always 2 problems, right? People that don't have money, people that have money, and they're both problems because the people with money want to spend it. That's all that people want to do because they don't know what to do with it. They're just
Yeah.
looking at it in the bank and they think, what do I do with that? People with obviously no money always want money, but that's not really who we're talking about today. So I think going into those places where people do have money. I mean, I've sat down with an investor before that showed me like bank statements, what it's costing him to obviously our Coots accounts, obviously. For those that don't know, Coots is like, you need £1 million to even open a bank account.
Yeah.
Showing me the fees and stuff. He was like, I don't want this money in it. I want it out working. And I think if you can tap into those kind of circles, you get that scalability, which is obviously what you're kind of alluding to there.
Yeah.
So I suppose focusing on the technical side of borrowing that money then. So assuming, let's say, £1 million from the off, was that like, right, let's have £1 million on drawdown, or that's £1 million, right, need to go and spend it. And then I'm assuming then the 10%, if that's what it was, interest, 100 grand a year, is being then paid down by the rent roll that you've sort of created within the portfolio. Is that right?
Yeah, so we'd draw down on the money.
Okay.
So we didn't want to just get the money into our bank.
Sure.
So quite a lot of people say that, don't they? If I've got an investor, I'm just going to get it into the bank.
Yeah.
Well, as soon as you get it into the bank, you're paying interest from day one.
Yeah.
So then it's sort of like the chicken and egg, what comes first, the deal or the investor. But we drew down on the money, had loan agreement in place. One thing I didn't mention is this investor actually bought into our company. So he's an equity shareholder.
Okay.
So we pay interest free on the first $1 million. And then on the other 2.6 million, we pay 4%.
Right. Makes sense.
So it's a very good deal for us.
Yeah. Very good.
But it's insanely good for him because he's a big shareholder in the company, which, our rent roll is, at the minute, we're about 50% occupancy because we're stabilising the portfolio and growing it. But at 50% occupancy, our rent roll is about 300 grand a year net. Wow. So he gets a good share of it.
Yeah.
So it's great for him because he had loads of money and needs to park it in assets. And it's great for us as well at the same time.
Of course.
But for anybody else out there, I'd draw down on the money rather than just get it into the bank. And then I'd make it sort of like specific to that property. And I think we do quite a lot of JVs, especially on the big schemes. We do JVs because the biggest thing, especially being young in property, is just managing your risk. It's dead easy to just go and get a bridging loan and just not be able to pay it back. And someone once said to me, it made me think, it was like, if you're big enough to go and borrow £1 million, you're big enough for the consequences if you can't pay the £1 million back. And so you need to make sure that you are protecting yourself at all times. So we do a lot of JVs where we manage our risk, don't sign personal guarantees. And that's not us not signing personal guarantees. We do sign them, but there's just different ways of structuring deals, of profit agreements on the back end. Maybe us not having a shareholding in a company and we got a profit agreement outside. So you've got to manage your risk a lot. So I think doing a blend of loans and JVs is always good.
Yeah, I agree. I think it's managing that risk, isn't it? Like you say, and whilst you are young, although you've probably got something to lose now, but when you were just starting out, you probably didn't have anything to lose really.
Yeah, exactly.
A little bit different if you're borrowing money off your dad, because then your mum probably would have not spoken to you for 6 years rather than 6 months. So, but I think managing that risk and taking that risk as early as possible is super important. And I think then once you've got something substantial, it's then managing that risk, which a lot of people don't. With the commercial vows, with lending, borrowing money, and people think that there's property's easy. Nothing can go wrong in property. If I buy it, I'm guaranteed a return, and that's not how it works. And if you've got investors that have tied you up in loan agreements, and you've got a PG, and you've got a secure against your residential house, and all this horrendous stuff, and the deal goes sour, unfortunately, it's nails in the coffin kind of scenario.
Yeah.
So I think although it's important to protect investors' money, it's also important that it's usually a two-way street, that we're in this together. The risk is shared. It's not necessarily me taking all the risk if I'm PG in your money, because then it's risk-free for you almost. It's kind of finding that balance with everything you're doing, which is obviously what you're kind of alluding to there. But
yeah, I think one thing that I learned off somebody as well was, if you're taking on big interest payments and PGs, like you just said there, it could seem that you're taking on all the risk. So if someone wants you to give a PG, charge them for you giving them a PG. And I'd never heard of that before until like a year ago. but it's mainly on big development projects. So like you might be building houses, like 10 nice houses. But if you're taking on a PG and taking the risk, you need to get rewarded for taking on that risk if things go well. So charge people to give you a PG, obviously not on like $100,000 loan, but if someone's loaning you 2 million quid and they want you to PG it, then you are putting your whole life on the line. And you've got to treat the investor's money as if it's your money anyway. But if you're signing a PG, then all the risk is on you, when it shouldn't necessarily be, because they're in a win-win situation, because they're not going to lose the money, because they would have probably loaned it at 70% of what it's actually worth anyway. So yeah, charging for PGs is a interesting one. I've never done it, but I know people that do. And I think that probably shares the risk as well.
So kind of jumping around a little bit, but obviously 3 business partners. How do you kind of find the dynamic? Because, you know, I've had 3 business partners and we had quite a nice dynamic, but I know for some people it's quite difficult, you know, having that different personalities, different wanting to go this way, that way, particularly obviously the fact that you're in business with 2 brothers as well, that, you know, water runs thicker, blood runs thicker, you know, sort of thing. So how do you kind of find that setup?
It's insane, to be fair. Very, very lucky. We've all got exactly the same goals. We're all exactly the same people. Like, we love going out, having a beer, watching the footy. Like, we do loads of stuff together. We're all also very different people in terms of work. So I'm more out there. I'll go raise money, social media. Like, Adam has social media but doesn't really use it. Alex doesn't use it for property. I focus on all the outward stuff. Alex focuses on the back end, the admin, making sure everything's good. And then Adam's a perfect blend. He literally sits in the middle. So for me, in business, that would mean that I would go out and find, like, I'll get a deal sent to me. I'll read the numbers, top line, and I'll go, get in, what a great deal this is. I'll send it across to Alex. Alex does all the numbers, and then he'll come back and say, it's a shit deal. And I'll be like, fuck, nice one. But that's the way it works. And we've had arguments in the past, but not big ones, just disagreements on the way we should handle a situation. That's a good thing. Like, the disagreements have never been bad. We've always just like squashed it within like 20 minutes and just done whichever way we wanted to do. But yeah, it's good that we all have the same goals and we all do the same things, like go watching the football, go out for beers. Like, we're exactly the same in that way, but we're different in business, which is very good. Because if we were all like me, then we probably wouldn't be sat here because we probably would have gone bankrupt. If we were all like Alex, then we probably wouldn't have moved very far. Do you know what I mean? And that's no disrespect to either one of us. That's just the way it works really, really well.
Where do you think, okay, I'll ask it in a really simple question. If someone's looking for a business partner, you know, what sort of things should they be looking out for?
Yeah, good question. For me, it's someone that's just got the same interests as you outside of work as well, I'd say. Because I couldn't imagine stopping work for the day and then just not speaking to that person and then just starting the next day as if you live in 2 completely different lives. So people say don't do business with friends. I mean, Adam and Alex are my friends. Every single person I work with is a friend. So I disagree with that because I think like having that underlying relationship anyway is good. But then you need to make sure that you got boundaries. Like, we had one of our friends that came to work with us and there was clear boundaries. Like, this is business. Yes, we're friends. Anything goes wrong, if you're not with the company in 12 months, that's just pure business. And he's not with us anymore, but he took that incredibly well. And it's just setting the stall out very, very early in sort of the relationship. But yeah, you need someone that their goals align with you, because you don't want, and it can be a discussion as well, and it can always be like evolving, but you don't want, like Adam, for example, to say, right, I want to sell everything now and go on a beach. Whereas I'm like, I want to buy another 100. So you need very similar goals. But that's an evolving thing as well. Like, you work that out together. But you just need the solid foundation relationship at the start.
I think that's the key thing that stuck out to me, is that business is business. And, you know, if you can take that mindset into the working environment, I think it preserves, because I've had, you know, businesses with other people. I've had recently bought out by business partners, started 23. And I was literally chatting to him yesterday about the business that I used to be involved in. how things going, how's that going, what's that, and sharing, different ideas and what have you. And I think at the end of the day, I would call Matt, I'd call Matt my, one of my close friends, but we always had that business understanding as well that, we're in it to make a profit, and what happens here doesn't reflect, on the golf club or wherever, down the pub or whatever,
100%.
wherever we are. So I think that's a really vital point, really. And I think having the balance of those skill sets as well that you've alluded to, like you're, running at 100 miles an hour, what to do 10,000 deals in one day. Whereas Alex is like, hang on, mate, just chill your bean a bit and take a step back. So I think you've got to have that yin and yang scenario. Because, if Matt was like me, we'd probably been bankrupt and all sorts of stuff. But it's having that balance, which I think now I'm like a solo business owner. Like I miss that element of being able to say, oh, this is the situation, am I being absolute mental here, or should I go for it?
It's even harder when the times are bad.
Yeah.
Like being on your own when the times are bad, it must be, I can't even imagine. Like the times we went through, if it was just me, I'd be back in a 9 to 5.
I reckon, yeah.
Yeah. Just because just the amount of stress is just insane. Whereas like, I remember when the provider went bust, I remember just me, Adam and Alex just sitting in literally like a fucking 2x2 room, like tiny room. And we just sat there like banging our heads against the wall. Like, what do we actually do? And then you've got the staff outside of the room who just don't know anything. And it's like, Jesus, we literally sat in that room for like 12 hours. Whereas like if it was just you on your own, I don't know how you'd handle a situation, but it's much easier with business partners because you all have different ideas. And like, I think it was Adam that came up with the idea of the model we're doing now. So if I was on my own, I probably wouldn't have come up with that idea. So it's like different, we speak about the different things that we can do to get out of the situation, and then we just choose one and run with it. So it's much easier when you've got a group of people.
Yeah, I agree. That's probably why, they have big businesses, have non-execs and people like that to make, that broad idea of what can we do in this situation. Yeah, I think that it's important to have that in business, because otherwise you just, tunnel vision, particularly if it's your own business, it's only like usually when I go away on holiday that I'm like, oh shit, well, why am I not doing that anymore?
Yeah.
And then I'm like, right, change direction, go down that avenue. So I kind of get that. And obviously coming from business partnership to being on my own, there's definitely times where I've been like, I'm ready to go back to bed today.
Yeah, definitely.
Good stuff. So in terms of, I guess, moving forwards then, you've kind of alluded to it before then, you're saying 100 properties. What does that kind of look like short term to long term? What's the end goal for you guys?
The end goal, I don't actually know. We are still young. Like 5 years time we'll be 31. And like if we think of what we've done in the last 4 years, then the next 5 will be pretty scary. But I don't have an end goal of retiring, sitting on a beach or anything like that. I think we'll just always keep going. Obviously, we'll probably at a certain stage scale it back, and don't know, we might do different things. Like we might do nice holiday lets, or maybe we'll do something abroad or something. I think we just want to build a good portfolio and one thing for us is like super high quality as well. Like we recently won an award for one of our Ofsted schemes. We bought a derelict commercial building. It was derelict for 30 years, turned it into 3 flats for 16 to 18-year-olds leaving care. The finish on that was just ridiculous, and hence why we won the award for it. But I think just building a good portfolio of high quality houses, not going in and giving it a lick of paint. We did that on our HMOs. Our other competitors in the area were spending 20, 30K on refurbs. For a 4 or 5 bed HMO, we were spending like 40, 60K. So we've always gone above and beyond, which has helped us in the long term when shit hits the fan. So yeah, I think we're going to build a high quality portfolio. We've done some bigger schemes. We bought a scheme in Manchester Piccadilly, M1. It's 4,500 square foot apartment building. Literally can't get any more prime in Manchester, but it's just too stressful. The bigger commercial to resi stuff is more red tape, more things can go wrong, more money, more problems. So on that, for example, we'll spend probably about 1.2 million.
Wow.
Whereas, and yes, we'll make good money off it, but the amount of stress and the amount of time it takes, like we won't get paid on that scheme for 2 years. Whereas like if we spent 1.2 million in property in individual houses, we'll be getting paid within 4 to 6 months if we rent it before we refinance. And the risk is much less. You can bail yourself out of 100 grand. It's much harder to bail yourself out of £1 million. So yeah, build a nice portfolio, and we are going to focus on buy-to-lets just because it's simple. And I think HMO is a big craze. Rightly so, they're good. And I know some of my good friends do big commercial HMOs and they're just insane. But I can't see the massive hype with HMOs in the next 10 years. And I think there's always going to be individual families that will rent a buy-to-let. There's not always going to be people that will rent a HMO, is my personal opinion.
I agree to yeah. I think built up areas like Manchester, I think HMOs will always do well because it's kind of got that, nomadic living kind of scenario. Whereas like outskirts, like where, you live, Cheshire, like HMOs, unless it's a built up area like Crewe or, somewhere like that, there's, depending on where you are, there's the urban areas are just, I don't see the sustainability with them because people want to live in family homes. I mean, obviously we've got a 4.3 million house shortage at the moment, so people are going to need somewhere to live at some point. So that's always going to be a major factor unless, the government change that on in the election. Obviously we're recording this before the election, but it'll be out after the election. So let's see how that ends up. But I think I agree to a certain extent. I mean, buy-to-let's always safe. I mean, landlords are exiting the market left, right and centre. The regulations, Section 24, various reasons. Rent's not as good as it was because of mortgage rates. So I think that's only going to put pressure on rents anyway. And if you're buying now, I think that's going to, in turn, push property prices up, which haven't really gone up with inflation. If you look at where inflationary numbers are versus property prices, it's not gone as high as inflation in terms of like the consumer market. So I think there's definitely growth there for sure. So I think it's a sensible, slow approach. Well, even though you're doing big projects, but it's slow from even a scalability perspective. It's catch your monkey rather than big commercial cash flowing HMOs that
Don't get me wrong, we'll still do them. We probably will chuck in a few HMOs a year because I do like them. So I don't want people to think that I'm slagging off HMOs.
You're just saying that so people stop buying them.
But I just think buy-to-lets are so much safer.
Yeah, I agree.
And there's less development risk. Big commercial HMOs, you're spending 150 grand on a refurb and you got to go through planning. And it's just more development risk. And one thing we've figured out is the more development risk you take on, not necessarily, you're not necessarily getting better returns off it. Sometimes you're just taking that risk just to finish the project and break even. So it's just getting the balance, but each to their own, I guess. But we've done tons of HMOs, so we do like the model and we still own 26 of them now. We're just going to slow that down.
Yeah, makes sense. Nice. So I guess to round the episode off then, if people want to find out more about the network or get in touch with you, how can they go about doing that?
Just through my Instagram,
which is
Aston H Property.
Cool.
Probably the best way.
Yeah, we'll put the details obviously in the description wherever it might be on this video or audio. But really appreciate you obviously coming on today, Aston.
No, thank you very much, mate. It's been good. Good to meet you.
Good stuff. Well, thank you very much for tuning in today. Obviously, if you're watching on YouTube, don't forget to subscribe and like. It does help the videos. And if you're listening on audio version, please do leave a review. We'll see you again on the next episode. Take care. Goodbye.